Hey everybody, how are you doing? Hope everyone's having a good week amid some hectic times. Excited to bring you a very topical panel today. We're going to be joined by some of the best experts in the space who are going to help us untangle some of the recent correlation and influence of macro on crypto markets, as well as make sense of a lot of the crazy information that's been thrown around. So, without further ado, we'll go ahead and bring on each of our panelists for today, starting with Noelle Acheson. Uh, Joining Noelle, we have Radu and Shawn. And so we'll go around and do a quick round of intros from everyone first so they can give you their incredible backgrounds. But first, I have to read a short disclaimer. The information contained in this webinar is for informational purposes only and should not be considered as investment advice. So with that out of the way, thank you for joining us, to our panelists and to our guests. If you have any questions throughout, feel free to toss them in the comments. If we have time at the end, we'll touch on anything. But let's go around, starting with Noelle and then going to Radu and Shawn. Could you guys just give us the short overview of your history and tell us what you're up to these days?
Sure, Jack. Thanks very much. Great to be here. Very short overview. I've been a crypto analyst now for just over 8 years, most of them focusing on the institutional interest. That included 5 years at CoinDesk, where I ended up as managing director of research, and just over 1 year at Genesis Trading, where I was head of research there. I left Genesis in end of August, to focus on an independent project, which is called Crypto's Macro Now, that involves some writing work, that long form writing that I'm working on, as well as a newsletter. Feel free to subscribe.
Awesome, thanks. Yeah, Radu, feel free.
Sure. Thank you for having us, Jack and Ty. So my name is Radu Gabudean. I'm heading research for the multi-asset strategies team at American Century Investments. So I guess I'm thrown here for TradFi ballast, if nothing else. I've been with American Century, so that's a traditional asset manager for about 10 years. Before that, I was on Wall Street for some time doing quant research. And before that, I was at NYU. I got a PhD in finance from Stern.
Awesome, thanks. Last but not least, Shawn, take us away.
Yeah, it's Shawn Douglass, co-founder and CEO of Amberdata. So we provide a lens into everything that's going on in the crypto economy and went on the spot markets, derivatives markets, options venues, as well as on-chain data. We started Amberdata in 2017, really focused on empowering institutions to identify opportunities, manage risk, and build their businesses around crypto. And prior to that, been involved into derivatives and trading primarily energies, doing options volatility arbitrage. So I always look at crypto as another macro asset. But it's interesting times.
Yeah, absolutely. And we'll dive into all of that and even hopefully have some time to touch on some of this FTX drama that's unfolded and wasn't originally on the docket, but we would be remiss if we didn't talk about a little bit, I think. And so, yeah, without further ado, I'm Jack. I'm VP of Research at the TIE. Very excited to have everyone here today. And we might as well start with the very basics, right? We've talked about some of these, hey, crypto is a macro asset. Crypto is increasingly correlated with equities. First of all, what does that actually mean when we're trying to contextualize the fact that crypto has become more correlated with macro? Where is that starting point, and then where is it now? And then as we kind of move beyond that, if we do expect crypto to decouple, like first, is your opinion that we will decouple at any point in the near future? And then what actually makes that happen? And so I know that was a lot to cover. So I would be interested in starting with Radu, because I know you mentioned that you had done some work on some of this correlation stuff. So I would be interested in hearing you talk about that to kick off and then go from there.
Okay, I guess I could probably speak for a whole hour, so definitely kick me in the leg or something if I go for too long. So I guess try to set the framework somewhat, right? So you got to think about the correlation of two assets, or macro and crypto. And I guess by macro we mean could be the U.S. equity market in general, like the broad traditional asset classes. If you look at the valuation of an asset class, it's driven by two major things, right? This is Finance 101. The cash flow that you receive from that particular asset and how that future cash flow gets discounted to today's value. Now, the discounting part, so that is actually quite important these days, because the fiscal environment, especially the monetary policy environment that we are in right now, affects all the assets via that discounting. Right? So money are becoming expensive. All asset classes need to produce a higher return. That means their prices need to come down now. Right? So that's why you see this correlation across asset classes, not only crypto, right? I mean, even stocks and bonds that traditionally have had an inverse relationship. They've been going down together for almost the whole year, and then they somewhat recovered over the past month or so. Right, so you see this as a broad-based phenomenon, and is driven by the fiscal policy, which is in turn is driven by inflation, and which in turn is driven by et cetera, et cetera. Right? I'm not going to go all the way to I guess founding fathers. So so that's one chunk, right? And then the other chunk is the cash flow that you receive, the future value that you receive from these assets. And I think that's where, if there's any decoupling, that's where the decoupling happens, right? So, for example, stocks and bonds, we know that the cash flow of bonds is pretty stable, right? Like, it's way ahead of time in nominal dollars. The cash flow from stocks, it's very risky. It goes up and down with the economy. Or for a particular stock, if, let's say, a founder commits fraud and goes bust.
Only hypothetically, of course.
Only hypothetically, of course. So now with that, so you're gonna have to look. Okay, so what's the relationship between the cash flow of crypto, or the future value of crypto, and the future value of, let's say, a broader market, stock market or macro? And I think there we can spend probably quite a lot of time, and I am probably the least qualified on all this panel to speak to that. What's the value add of crypto? What's its value proposition? And that value proposition might as well differ from like different categories, right? Like, stable coins, or DeFi, or Bitcoin and Ethereum. Even the two of them seem to be diverging and so on. So trying to understand how that value add differs from, let's say, what you get from investing in just the broad stock market. That's where your correlation will decouple or stay coupled.
Yeah, no, that's really interesting. And I guess, Noelle or Shawn, when you both are looking at this combination of macro factors and crypto specific factors, when you're thinking about decoupling, do you think about it differently from, okay, this asset pays yield in in dollars or in stable coins, and so it has to outcompete, dollar asset yield to actually decouple, versus maybe Bitcoin is playing a little bit of a different battle because it's playing more against itself? Do you think about it in that way, or how do you kind of contextualize this?
I'll dive in there. I do think about it in a much simpler terms, because in the end, correlation is you calculate correlation based on prices, and investors calculate their returns based on prices. So it's the prices that matter, and especially with an asset class such as crypto, which is so difficult to value. There's no cash flows, as you pointed out, Radu. There's no established valuation models like we have with bonds and many types of equities. So valuation there is entirely subjective. Investment theses matter a whole lot more, and I believe they are going to play a much more important role in the decoupling. We've already seen that, as you mentioned, Jack, through some rather unfortunate blows. We saw this back in May and June as well. Decoupling, which we all wanted, but not in that direction. We noticed that the correlation using the 60-day Pearson between Bitcoin and as you say, Radu, let's take the S&P 500 there as the macro index. It started heading up. It crossed zero and headed up fast, in fact, in around about beginning of April, which is precisely when the fears of higher interest rates kicked in, according to the data that we have through the futures markets. So I believe it was sentiment that sent the correlations shooting up. Fear sends correlations to one, as we all know. And the decoupling is going to come from, I think, three different areas. One is the unwinding of that fear, the return of risk assets, if you like. The pace of rate increases is likely to start coming down. We've seen hints at that both from the Federal Reserve in the US, the ECB, as well as the Bank of England, and they should start to perhaps actually come down rather than just decelerate second half of next year. So the return of risk assets, that's longer term though, and that also isn't going to be quite as impactful as many think, because the S&P and the Nasdaq are both dominated by risk assets these days also. There's also the growing understanding of Bitcoin's unique investment theses, and Bitcoin being the bellwether, the leading asset here, tends to lead the pack. The unique investment theses being the decentralized, seizure-resistant, liquid, auditable store of value. That, just reading the headlines these days, we can understand why there would be a growing demand across the world for something that has a provable fixed supply. But then even more important, the decoupling, I think, will come from simple flows of funds. The thesis that we've mentioned for Bitcoin is going to largely attract a new type of investor, and then we can start to think about the marginal investor. What all bull runs are driven by new types of investors. The previous bull runs of crypto are no exception. The next one will be no exception. What new types of investors have yet to come into the equity market, the bond market, versus what new types of investors have to come into the crypto market? The marginal investor, flows of funds, and smart investors will be thinking, whatever their belief in the crypto thesis is, where's the money going, and get in with the crowd. So those three things: the return of risk assets with the removal of fear, the understanding of the theses, the unique theses behind crypto assets, and flows of funds through the marginal investor.
Yeah, I think both, Radu, you summarized kind of the, generally basic classical finance theory, and I think that there's, and also, both you and Noelle talked about correlations, and I think, markets in short time horizons or in long time horizons are sometimes correlated, and things trade in a range until they don't, and there's a catalyst that changes things. Which I think right now there's things that are decoupled. Look at the price of crude oil right now. Crude oil is dropping, but the EIA inventories are low. There's all kinds of risk that potentially that should be going higher, but things can decouple. If you look at from a thesis, there's two major trends that are driving crypto, and I think one, like if you look at Ethereum and smart contract based platforms, it's a platform for financialization, and it's effectively the financialization of the internet. And every financial institution, every bank, it has not fallen. They're not blind to the fact that FinTech 1.0, you basically factored payments out of banking, and now they're looking at crypto and going, wait a second, I could write an application once, I could run it. My total addressable market is every person and every business on the planet. It costs me nothing to run that, and I transfer the cost of those transactions to my customers. That trend, I think, will continue. I think that thesis will continue. That's the thing that's compelling. The case for Bitcoin as a store of value, even though it's been a brutal store of value for the last year or so, is schmuck insurance. The Fed and the U.S. government have been exporting dollars and inflation to the world right now, but how long can we do that? If the Fed raises in interest rates to 6%, can we even service our own debt? Unlikely. So at some point, where does this go? And then that goes back to, okay, well, if the debt probably of the US is not serviceable above 6%, then what can yields be? And then do people actually trust treasury bonds to be that annuity of coupons paid over time if at some point that entire system is at risk? And so therefore, what should yields be in these DeFi, which is assets, which at the end of the day, they're much riskier. We all realize that, but I think there is an upper bound of what people and a lower bound as well as what people are willing to accept for the risk of what's going on. And then the last piece is, I think that if you look at 3RL, Celsius, BlockFi, you just go down the list, you realize people just relearn counterparty risk. We've seen this with MF Global. We've seen this with Lehman Brothers. We've seen this over and over and over in financial services. I think crypto is relearning the lessons of old about counterparty risk. Now with FTX, it's probably more of an Enron moment than it is a a Lehman Brothers moment, I think. And the thing that's surprising to me is, why is Bitcoin not trading at 8,000? And it's, to me, it's like I think the people still long term are looking at this as a store of value, even though given that we've lost as much as we have in the value. It's just not the first time it's happened in Bitcoin.
Emerging store of value, I think that's the latest.
Emerging, that's a very
emerging store of value. But Shawn, you raise a really good point about the dollar. And when we talk about correlations, as you pointed out, Radu, we assume we're talking about the S&P 500 because that's macro, right? Well, dollar is pretty macro as well. And we don't focus as much as we should, I think, on the correlation between, and I'll use Bitcoin as the bellwether here, between Bitcoin and the dollar, pretty consistently negatively correlated recently. Whenever the dollar's risen, Bitcoin has fallen, and similar because of the macro influences. But also, let's not forget that the dollar is the denominator of the equation that we normally use when we quote Bitcoin. And I noticed today, first time I've seen in ages, we had weakness in the dollar and weakness in Bitcoin. Could this be the beginning of a decline? I think it's too soon still, but Shawn, you gave some very compelling arguments for why the dollar is going to be changing direction fairly soon, exactly at the right time when the thesis behind Bitcoin becomes more apparent.
Yeah.
No, that was great. And I think it gave us a ton to unpack. And I think I want to go through it one by one. But one of the interesting questions that is really brought up on the back of both of the things that Shawn and Noelle just said is, when you compare it and actually use the dollar as your denominator, stuff kind of makes a little bit more sense, especially on the Bitcoin side. And that kind of makes sense, right? Ultimately, the dollar is a store of value. It's designed to facilitate liquidity and commerce. And Bitcoin has a lot of the same core tenets, just taken to kind of the logical extreme of decentralization and risk-offness. But on the other hand, Ethereum and a lot of the other layer 1 blockchains are really, really different in that there's this increasing awareness, especially after Ethereum's shift to proof of stake, that Bitcoin and Ethereum are really two very different things, right? Like, one's a bet on digital store of values, and one's an investment in financialization of blockchain technology. And so when you're thinking about correlations, does it even make sense to kind of use the same denominators for both of these assets, or should we really be changing the way that we're thinking and framing some of this stuff?
That's an excellent question. And the theses, the denominator is the denominator. And let's face it, most of us still think in fiat. And so that's going to be comfortable. But the base case for both, that is something that is definitely worth thinking more about. The Bitcoin and Ethereum are very highly correlated. Huge spike, in fact, in their correlations just over the past week. Times of fear, correlations go to 1. We're definitely seeing that. This is after a period of a slight decoupling, very gentle decoupling, because of the differing use cases, as you mentioned, Jack. This is also changing, though. We have Bitcoin that is very much emerging store of value, if you like, but it is also a new technology, and we're seeing a flood of news about work that's going on in the Lightning Network. And ever since Taproot last year, we're seeing the talk about smart contracts emerging, very early stages, but reminders that Bitcoin is a new technology as well as a store of value. And then we have Ethereum, new technology, definitely, but with emerging store of value characteristics since the IP 1559, and especially since the merge with low or possibly even declining new supply. So Bitcoin, store of value, but also a new technology. Ethereum, new technology, but also a store of value. So investors are going to be looking perhaps at the balance rather than choosing one or the other, the balance between the two of the different theses in their portfolios. Because I've spoken to many institutions that don't understand Bitcoin, but they get Ethereum because, oh, that's yield. Yeah, I understand that. Oh, that's collateralized lending. Yeah, I understand that. But there are also others that will only deal with the largest, most liquid, most sophisticated market infrastructure asset, which is Bitcoin. So it's a mix of narratives going on in there, which is very, very intriguing. But the denominator is, for the foreseeable future, going to continue to be fiat because that's what people understand.
You make a really a great point. It's like when I trade commodities, it's the dollars in the denominator. I want to know what's happening when the dollar, gold's going up, crude's going up, natural gas going up, down, whatever. Those are directly, there's a relationship, and there's usually a leverage relationship. When we look at crypto, we actually created a single asset indices for Bitcoin. So if you're going to look at any other crypto asset, you can do that on a BTC dollarized index. It's like the Dixie if you're trading commodities. But you can do that for crypto. So then you're like, well, if Bitcoin in crypto is the dollar, even though it's, I'm just saying as theoretically, it allows you to quantify and compare things. And the reciprocal of that, well, you can also do that for ETH. If you're trading an asset on ETH, using ETH as the denominator gives you a good, relative value to understand what's really going on here. And so that's how we look at it. But you made a great point, Noelle, about yield. Well, where does yield come from? In TradFi, it's that annuity stream from a bond that you're going to get paid coupons and you're going to be able to, but from where does yield come from in crypto? Well, there's really three places that yield comes from in crypto. One is if you stake an asset and you get, by proof of stake networks, you get this. Well, then there's also a component of that is from MEV, from the people who are incorporating the block. So that's one source of yield. The second source of yield is the, what's happening with futures versus spot markets. And you can look at what's the forward curve. Are we in contango? Are we in backwardation? What's happening in the markets? And that's something like our customers are, every day looking at yield, and they're looking at yield across different lending protocols. They're looking at the relative value of that yield versus the underlying, Ethereum protocol network that they're on versus, because it's a flight to safety. They're like, I don't know what's going on. Everything's melting down. Where do I go? I don't want to go to dollars because I'm already in crypto. So therefore, what is safe? Or what is, where can I park this to generate some yield? Or can I just hey, I want exposure to a 250 vol asset and I want to go sell some puts, or because I'm still bullish or whatever. It's really, really interesting because at the end of the day, yield, old school is, you're doing covered calls, right? Today, there's like 5 or 6 different creative ways to generate yield in crypto, from very simple generate yield on an exchange to, it's play the spot versus futures to going down into participating in lending protocols or being a liquidity provider in different protocols, right? It's pretty interesting.
Now that's super interesting what you say there, Shawn, especially about thinking of what assets does yield get paid and what assets generates that. And when it comes to the denominator as well, one metric I look at quite often is Bitcoin versus ETH, Bitcoin divided by ETH, Bitcoin ETH. Not for trading purposes, because my brain is not capable of doing those kind of calculations so fast, but for narrative purposes. When it's going up, that means that Bitcoin is outperforming. When it's going down, that means ETH is outperforming. What does that say about the market sentiment? So it is a very good exercise that you point out there of looking at different denominators just to understand what the market is thinking.
There's another interesting. Go ahead. I'm sorry, Radu.
Yeah. I was thinking about you talk about yield here and the traditional assets. I mean, yield comes from or return comes from economic activity, right? You give the assets to someone, they build the factory, stuff gets produced, and so on, right? So going back to what's the value proposition of digital assets? And you guys, for the past 15 minutes, have been articulating that quite eloquently, right, on the store of value and building the next financial system. And so there is value there. So I think again, when we think about correlation and relationships and so on, think about what's the value proposition, and we have it there. I'm also going to talk to you a little bit about the next financial system, like DeFi and so on, from the perspective of someone that's in the current financial system, so to speak. It's nice to see. The way I would see it also, it's a sandbox right there. We can explore all kind of things. So we can take risks there, create new products. Sometimes they blow up, so it's important that the sandbox has pretty strong walls that they don't break and spread all over the place. And I guess probably the regulators now will come in and try to reinforce those walls somewhat. So I think it's important to see it as a risky place, but not necessarily a bad thing. It's a risky place. That's a place where we should take risks. We should try to develop the new things. And then once they are mature enough, they're going to get adopted into the mainstream financial system. So with that, maybe I can shift the label from TradFi to mainstream Fi and exploratory Fi.
I like it.
It's really interesting. Is going to part of the question that Jack asked earlier was about institutions. Like, how are institutions participating in this? Well, timely, FTX was the only place that you could trade dollar-denominated futures before. That's gone. So now we're seeing, and we've seen this being developing for a long time, but there is now banks that allow you to trade non-deliverable forward futures contracts, and now it's basically private banking or CME. So you're back in TradFi land, but exposure to Bitcoin without having to worry about custody. And they're also there's many financial institutions that are also creating structured products, which give an investor exposure to crypto yields without them having to custody, without having to actually participate in DeFi, and they replicate that synthetically. The exposure for these investors, because there's a lot of people right now going, hey, Bitcoin, why is it not at 8,000? Maybe this is the floor, time to sell some vol. I would sell puts, but I can't because I can't hold it and I can't custody it and whatever. So via structured products, there's now quite a few institutions that through private banking to their clients, et cetera, are doing that. And then the last piece that we're seeing coming in right now is we're seeing banks and financial institutions developing and FX stable coins. You want to trade, you want a euro stable coin or yen or whatever. And the stable coins, they're like, when's the last anybody try to just go wire money across internationally? It is ridiculous what you have to go through, the cost, the pain, the number, like the reduction of friction. Not even talking about remittance, just like stable coins between banks. It's a way better platform. It's faster, it's cheaper, it's transparent. You know exactly what happened, where, when, who touched what. Regulatory purposes wise, the transparency that's available in digital assets and crypto is exponentially better than anything in TradFi. And so if we can not screw up the regulatory landscape because of the FTX blow up, which is a bad actor situation, and get some good regulation, it's going to just make this go parabolic. But this is kind of it. There a lot of ugly stuff happened in the last 3 months. Hopefully we get out the other side of this and it changes the game.
Yeah, I'd love to kind of turn that point you just made into a little bit of a question, because it's something we've been thinking a lot about, and something, on both a personal basis and as a research team and as an industry, right? Is on the one hand, you need some level of demand from the average consumer who isn't ready to effectively learn HTTP to use Google, right? Like that's where we're at. You have to understand the intricacies of blockchain to interact with any of the applications, right? And that's just not realistic. But simultaneously, a lot of the failures of this entire cycle were born out of centralized offerings of DeFi products without sufficient warning or consumer understanding of what they were actually buying, right? And so part of this is a little bit of a double-edged sword, where we need to find the right balance of disclosures and actually limitation of some of these high-risk products to people that don't actually understand what they're buying. But you simultaneously need to reduce the actual difficulty of getting onboarded into the ecosystem, whether that's through the wallet level or through a more seamless onboarding process on the UI UX level. And so the question that I'd like to kind of pose is, how do we use some of the unique technology that blockchain has, whether it's through exchanges doing stuff like proof of reserves to help transparency around liquidity, et cetera? How do we actually use some of this technology to get to the same kind of value proposition that regulators want, that traditional finance or as Radu called it, mainstream finance, or whatever the term that we wanted to use is, right? Like, how do we get to the point where regulators say, okay, we've actually achieved a similar value proposition, but we've kind of come at it in a way where we're using tools and not just trying to shoehorn in all of this stuff that worked that kind of worked even, right? And part of the reason we're in crypto is because it didn't work fully, right? Like, how do we get as close as possible, but still do something unique? And so I know that's a huge question, but would love to hear your thoughts.
I'd like to go first on that one because I live this every day. So first, I don't think we need more regulation that protects investors, because the SEC has sucked at that already. So I don't think that helps the situation. I think people should be able to quantify opportunities, take risks, and manage their own exposure. Now, what does crypto bring though? Crypto brings radical transparency that does not exist in any other financial market. We can tell you what happened in this wallet. Was there a swap? What price did it go? Where did it go? Who held what when for how long? And we can quantify the risk and exposure of everything systematically as well as at each individual. That doesn't exist in TradFi, period, full stop. You can't even figure out if you got traded futures on your favorite broker and it went to CME, what the hell happened? Good luck if you got a bad fill. Just forget about it. Like the transparency is exponentially better. The risk management can also be exponentially better. And I'll give you specific use cases of that. So today, Aave, Maker, Compound, cumulatively is about $30 billion of total value locked. There is dynamic risk management and incentivization for the economy and the ecosystem to go and clean up accounts that have over leveraged themselves and that are risky, that are unhealthy, and they're incentivized to do that via liquidating those accounts, which cleans up the risk for the whole ecosystem programmatically, and people get paid to clean up that risk. And then I also think that primarily the biggest problem with all of these lending platforms and the exchanges has been their closed systems that you can't see what is going on, and there's been fraud and they've misrepresented their holdings or they've over leveraged themselves. So when there became a liquidity situation, guess what? They didn't have the funds. They loaned it all out, so they blew up. Where with DeFi, you can actually see what is going on in every pool, what is going on with every swap, what is going on with dynamic interest rates, fixed interest rates, what are flows out of pools, what are flows across chains, what are flows in stable coins? Is it a risk off day? Is everybody moving out of a risk asset into stable coins? Or is everybody getting long by a perps that are in a synthetic option? Are they, what is happening systemically? There's so much transparency. It's not easy. This is my full-time job, but it's radically different. So with the ability to see the flow of funds, to understand the systemic risk for each protocol, and then who your counterparties are with proof of reserves, there's never been this telemetry to understand risk and quantify opportunity and cash flows ever before. You can see cash flows for some of these things, like you get Amazon's quarterly report. We can see today Uniswap made $1.4 million in fees, and we can tell you right now. So I really think that we're in a unique environment. There's some ugly stuff going on, but I think that where we're going is a better place.
Beautifully said, Shawn. Totally 100% agree. And let's not forget that it was on-chain forensics that started to shed light on what had happened with this whole FTX. A lot of it conducted on Twitter as well. Real-time communication. You don't get that in any other asset class. A lot of the institutions...
TIE included in that, by the way.
Absolutely.
They do a great job.
Hats off to the team at the TIE. But I speak to a lot of funds who, when they understand that we can see who bought what, when, at what price, and what they have done with it since, and what else they hold, maybe their heads literally explode. But figuratively, certainly, it is quite absolutely astonishing. And when you were mentioning, Jack, what do we need to do to get to a place where this, is used, and what we're doing, what firms like Shawn's are building, and what you're working on at the TIE, Jack, step by step, we just do it. And we're getting there. When it comes to DeFi, it's like parenthesis here, what we have seen from the complete implosion in May and in June and this month so far, DeFi has been resilient. This is something that not just users and investors are going to take note of, but also the regulators. They can't understand how to regulate DeFi. Well, look, it doesn't actually need it. As you said, Shawn, doesn't need it. It's performed just fine. It is not very usable, as you point out, Jack. And my theory is that's on purpose for now. We don't actually want the mainstream piling into DeFi just yet because it's not quite ready and the clarity isn't quite there. But once it is, we will get much better UX. I tried to use, Curve the other day. It is difficult, and I'm in the industry. But that's, again, on purpose to make sure that for now, only insiders are putting funds at risk. we will get to a better interface. That is how technology evolves, and it should be, in the case of DeFi, in my opinion, done carefully and slowly as it is being done.
Awesome. Great to see you back, Radu. I know you're having some internet issues, but
you know what I just did? I turned off the VPN, and now it works. So talking about StratFi and DeFi. So this is, obviously I have the VPN because security issues and so on. So too much security slows you down.
Yeah.
That's sort of the lesson.
Trade-off.
Yeah.
Awesome. Well, thank you for some thorough answers, and would love to kind of actually turn to Radu and think about some of these topics where we've heard on our end, right, Shawn and Noelle, the institutions are coming for years now, effectively, right? And for the first time, they may actually be coming, right? Like we see JP Morgan executing on Polygon via Aave. We see continued uptake in interest despite the bear market, and actually understanding where fundamentals lie and how to understand them. If we kind of continue to grow and fill into that role, Radu, I'd be really interested in hearing from you first. Where do you think, beyond Bitcoin and Ethereum, what are going to be the most interesting areas and opportunity sets that traditional financial firms can kind of get behind and relate to as they first enter the space?
Right. So I think got to think about the various use cases for digital assets, and particularly blockchain. Right. I mean, our firm, for example, is in a pilot with Swift and Symbiont on that financial data integrity project. So on blockchain usage, there's a lot of experimentation, particularly on the operations side, right? So that's one area where like things are moving forward. I mean, other areas, it really depends on security, right? Like, how do people feel safe? And security is not only hacking, but is it? Can you have another FTX blow up? And then you can also look at volatility of returns, right? If you have an asset that's very, very volatile, it's unlikely you're going to put someone that is looking for a sort of traditional investment portfolio in there. So I think that question has different answers depending on which use case you're looking at. And in general, the answer will vary based on how safe that application is. So again, look at something like a blockchain, trying to figure out data integrity and so on. That's safe. That's happening as we speak. You look at should we put retirement money into Bitcoin and ETH and so on? That does not seem safe. So I don't think it's going to happen anytime soon, right? I mean, FTX is a case in point. So as guardrails are built around these various use cases, as we get more experience with them, right? So again, you try things first in the sandbox, see how it works. There are no blowups. It gets safe. Okay, we'll kind of move it further into more mainstream, and then maybe more mainstream. Right.
Got it. Yeah, I need to make some changes to my retirement portfolio after this call.
Yeah, right. I will disagree with you, Radu. I'm long as hell.
Retirement portfolio is the one where you're 100% long crypto, right?
Exactly.
I have to disclose. Yeah, I'm not selling. I'm not selling any financial products, right? This is not representing the view of the American century and so on. So.
Got it. So I think
all the disclosures at the top of this discussion are applicable. But yeah, sorry, go
Jack,
on.
I think it's interesting from an institutional perspective. Like institutions are coming, institutions are here, and they are leaning in hard right now. And this is, yes, even with FTX happening, I'm talking to every one of our customers right now, and they're like, yeah, this is an Enron moment. This is not a get out of crypto moment. And the biggest banks on the planet are the biggest financial institutions I think the thesis remains strong. Yes, this is a bad time for global macro. This is a bad time for geopolitical. This is a bad time for crypto. There's a lot of things that are bad. However, just look 5 years out. And that's what I think right now. And if you look, what's changed to make this so institutions can participate from, say, 2 years ago? So custody's pretty much figured out. You have big players like BitGo, NASDAQ, Fidelity, Nomura that have institutional custody platforms. They're banks. Guess what? They hold stuff. Crypto's no different. They hold stuff, right? And you have previously, it used to be crypto was people who trade. Guess what? People love volatility. You make money. You don't make money trading if there's no volatility. So, hey, this is a 100 vol asset that currently is a 250 vol asset. Guess what? You can lose a lot of money if you manage risk well. People want to do that. However, what's changed is now tax firms. We have 3 of the largest tax firms in the US are now can do crypto taxes because they have access to the data. You have accounting firms. We have many of the large accounting firms now they understand crypto and they know how to account for it and then get the time series historical account balances of who held what, when, at what price, and then when did they get, and what was their cost basis. They're able to do that. We have several of the big 4 accounting firms that now they know how to audit. They know how to go, show me proof of reserves, show me that you held this, show me this. And then regulators are also becoming much, much more sophisticated for the ones that don't have their head in the sand. There's people who have really gone down the rabbit hole. The CFTCs, their crypto team's pretty sharp. They deeply understand this. And then now finally, if you look at TradFi, derivatives is like $400 billion a day traded in derivatives between, all in TradFi. The derivatives market today is largely Deribit, but you're starting to see both NDFs developed by banking as well as multiple derivative markets around the world. And that's really where things are going, is that derivatives give you a sophisticated instrument that you can manage risk and you can make more intelligent bets, based upon volatility, based upon time, based upon, capture yields, do all kinds of things. That is going to be one of the things that enables institutions to create structured products that can give their customers exposure to this asset class without having to have just straight delta exposure up and down. Because delta is delta, it cuts both ways, right? So I think really that's what's changed over the last 2 years is institutions now have the infrastructure as well as data. Like I do data all day long. They have the data infrastructure as well to be able to, identify opportunities, quantify risk, and account for what they think is going to happen and what has happened. And that's fundamentally different than 18 months ago where, that infrastructure just wasn't mature today.
I'm going to agree with Shawn that the infrastructure is a key part of the institutions coming, and sure enough, the infrastructure is sophisticated now, certainly compared to the early days. I'm also going to agree with Radu that for many institutions, this is a let's go a bit slower than we were planning to moment, while many of them reevaluate the risk and their partners and ask for all sorts of due diligence that they thought they were taking for granted earlier. But I'm going to be the pedant of the group and say, what do we mean by institutions? Institutions are such a vast range of entities. We have the risk seekers that Shawn was talking about. They came in back with the ETF back last October. Sure, there are many more that have yet to come in, but yeah, they love the volatility and they've been here for a while. We also have the pension funds that have been dipping their toes in, not very successfully so far, but this is something that pension funds could find very attractive as a diversifier for their portfolios, given that they certainly need some help, given the funding requirements coming up. And then there's the insurance companies, and then there's the longer term funds, and then there's the mutual funds, and then we have the banks with their services. They have a very different lens, and they're looking at how can we make money on this. And then you have the whole tokenized securities things that the banks are definitely thinking of, and you have the issuers who are thinking, okay, how can we make crypto assets that represent the securities that our investors know and love, but are more efficient, transparent, et cetera, et cetera. So institutions is such a wide range. Yes, they are here, but we have had a very big blow over the past week. So there are going to be some that will be going slower. But when things turn in the macroeconomy, and this is something that I've been focusing on a lot recently, the overlap between the crypto and the macro landscapes, when things start to turn in the macroeconomy, which we all sense is coming very, very soon, then that paints a very different investment outlook for crypto assets as well as macro assets, for the broad macro investors that I was referring to earlier when I talked about the marginal money on the sidelines that has yet to come in. So they're here. A lot more on the sidelines waiting to come in, which is going to drive the next bull market. But we have had a big blow, which is going to perhaps slow things down a bit.
Yeah, I totally do agree with you, Noelle. Absolutely. What do you think with, say the dollar does turn and you have a halvening coming up in Bitcoin in a year or two, then you have Ethereum that's a deflationary asset. I mean, that could be the next bull market. People start to actually see that, right? I mean, people poo-pooed the stock to flow there as the market crashed, but it still kind of holds true for at least commodities, right? With gold or what have you, right? I don't know. Maybe that starts to come back into favor or what have you. I mean, it's difficult how to quantify.
It could be. The halving is a very key factor. You're totally right in bringing that up. It has held true, not just because of the reduction in supply, stock to flow, if you want to use that as the model, but also because the attention it gains, and it tends to continue rising sometime after that. This is going to be the first time, however, that we have a halving when crypto is part of the macro landscape. The last one, it was still very niche. This is also going to be a halving that's going to be occurring in a somewhat, shall we say, fractious is the word, macro landscape, which is going to affect the overall investment mood, but as well as the attention on this provably scarce, seizure-resistant, liquid store of value.
So so on the deflationary parts, I'm a little bit confused on that thesis, right? So, supply is restricted or fixed or close to fixed. Okay, so I got that part, but price is determined by supply and demand, right? So demand is varying as it varies with sentiment. It varies with the use case, and etc. Right? I mean, the next bull case can come from increased demand because people see the value in ETH to do DeFi, etc. So that should move the price quite a lot. So how is that deflationary, right? So that's what I'm trying to understand. Like, the deflationary thesis looks only at supply, but I mean, basic economics says you got to look at both curves, like supply and demand.
Well, deflationary, the fact that ETH becomes deflationary is itself a factor of demand too, right? So you have to also factor that into discussion, where ETH only becomes deflationary. It's like right now at current levels when gas is over 18 gwei or something like that, right? And gas consumption is fundamentally a factor of demand for block space on the ETH blockchain. And that becomes only more true as we grow to a vertical scaling environment where block space on Ethereum mainnet grows more and more efficient too, right? And so part of the idea is in an environment where Ethereum is deflationary through a combination of the total amount of staked ETH and blockchain inflation for validation and demand on chain, you end up with what will be a hopefully fairly consistent supply level with some percentage of that stake that ends up being blockchain inflation that is just and right around like the GDP number, which is demand. And so the idea is you kind of end up with naturally floating monetary policy where one is a factor of demand on chain and the second is a factor of total staked ETH, which is the baseline rate of the Fed of Ethereum, right? And so that's kind of how they've decided to structure it. It's pretty interesting. We'll see if or how it ends up working, right?
And I'll jump in with my usual pedant approach to this. It's so much fun being a pedant. And that is, depends what you mean by deflationary. Are you talking deflationary in terms of supply or deflationary in terms of price? Can go either way. Also, there's a difference between deflationary and disinflationary. We often conflate those two terms and they mean very different things. But Jack's totally right about Ethereum. Bitcoin, different equation. Bitcoin is the only asset in the entire history of assets that I'm aware of whose supply has nothing whatsoever to do with demand. Nothing whatsoever. Gold, demand goes through the roof, price goes through the roof, we're mining asteroids next thing you know. But with Bitcoin, nothing will impact the supply, and the new supply coming into the market decreases. every 4 years. So it's more disinflationary than deflationary. But that's for me, you hit the nail on the head, Radu, with the simplicity of that supply-demand approach. For me, Bitcoin's thesis is really that simple. Supply versus demand. Supply will not change. And longer term, given what's going on in the world, given what we see as an increasing need for a seizure-resistant, decentralized, auditable, liquid store of value, whatever kind of, whatever you're coming from, whether you're fleeing with everything that you can carry, we've seen this in Europe so far this year, or whether you are a sovereign nation wondering how to keep your reserves safe from foreign interference. The demand for that kind of an asset, longer term, with the fixed supply, is one of the main theses behind Bitcoin.
Awesome. We're past time. As much fun as I'm having with this conversation, I could easily go on for another hour, but thank you so much, Noelle, Shawn, Radu, for participating. You can find Radu at American Century, Shawn at Amberdata, and Noelle, Crypto is Macro Now. Fantastic newsletter I read weekly. Like, highly recommend it. Independent writers are some of the backbone of the space, and so please check out everyone. Reach out to us if you have any follow-up questions of Ty, and it was great hosting everyone, and looking forward to doing this again soon.
Thank you so much, Jack. This was so much fun.
Yeah,
Thank
my
you.
pleasure.
Thank you. Really enjoyed it. All right.